I want to introduce Patrick Prunty of Marshall Reddick. Most of you probably know Marshall Reddick. It's a very large real estate firm that does investment advisory as well as traditional real estate as well as non-traditional real estate. And Patrick is going to speak to us today about private lending and passive income and how all of that works within the Marshall Reddick world and in general. And so with that, I would like to turn it over to Patrick and have him take us through a bit of education on this front.
Yep, absolutely. Thank you very much for the introduction. It's my pleasure to be with everybody tonight. I hope that we find the presentation that I prepared informative. It might be basic and common knowledge to some people, but I find that keeping it super simple oftentimes is the best route to go. I'm certainly open to questions and one-on-one conversations, individually after this meeting or whenever you're prepared to talk more details. I did prepare a PowerPoint, so I'm going to go ahead and share my screen if that's all right. Okay, so Private Lending 101 with yours truly. Now, I thought it was important to get started to have a little background on me and how I got started, that type of thing. I was introduced to Marshall Reddick as a college student. My parents were not necessarily real estate investors, but they were kind of like the millionaire next door. My dad traveled a lot, or moved a lot throughout California for his profession. And whenever he and my mom would move, they didn't sell their primary residence. They ended up keeping it and turning it into a rental. So, over a 30-year period, they ended up with 10 rentals in California from the mid-70s into the mid-2000s. And so everybody knows what real estate in California did during that period of time. So, I really learned the value of a dollar, and my parents were investing a little bit with Marshall Reddick in the late 90s and in the early 2000s when I was starting to become of age and understand financing and all these different types of things. So I got an internship with Marshall Reddick, and as most folks, getting started with real estate, I figured that I was going to own rental property, lots of it, and I was going to scale that and gain financial independence through that rental property. I did well, right? I got to about 15 doors, and what I realized is that having a portfolio of that size is just, it's not manageable for a busy professional. I realized that, or I estimate that I was spending somewhere in the neighborhood of 2 hours per property per month in terms of managing the property manager. Keep in mind, I always have a property manager. I never have rental property without it. And, managing the statements and tenants and dealing with the CPA and filing and making sure I had all my documentation and everything. And it just was something as a young professional trying to grow a business, trying to be a good husband and a father. It wasn't cut out for me. So I realized that it was more active and not passive, and I needed something more passive. I also learned that rental property is more about quality and not about quantity. So since that time, about a decade in, I started to scale back that portfolio from the 15 doors I mentioned in markets all over the country. And I have 6 rentals today. And don't get me wrong, rental property is a great thing. There's lots of benefits to it. I'm just not sure that it's the right investment for folks that are super busy, at least on any type of scale. Now, around that initial decade of real estate experience, I got involved in private lending. And I spent the last decade, after almost a 20-year career with Marshall Reddick, learning and becoming a professional in the private lending space. Now, I started doing this in 2009 on an extremely small scale. And I did so, you know, the market crashed, everybody knows about that. And I had some trusted contacts around the country, you know, through my Marshall Reddick experience and career thus far. And I specifically had a connection in Toledo, Ohio, of all markets. And so, you know, they approached me, this contact in this small operation. It was a brokerage and property management company, and they were just buying up as much distressed property after the fallout of that aftermath of 2008. And obviously the financing was difficult to get at the time. So they approached me and some of my colleagues at Marshall Reddick and, you know, asked if we would be interested in making some loans to them, you know, pay us 10% interest. And, you know, it dawned on me as a very interesting concept. And I knew the mechanics of real estate investment, but I really didn't know the mechanics behind lending and lien position and title insurance and all of these other things that you need to know about. But what I did have is sincere trust in that particular individual. And I kind of just started on a very small scale. I did learn the hard way several times. And I think that that's an important thing when you don't have the option to learn from others' mistakes. To be a really good investor, one needs to make mistakes and learn from those mistakes. But a lot of what I'm going to talk about tonight, I take from those mistakes I made, primarily unsecured loans, and secondarily would be junior, second or even third position lending. It's just not a space that you want to play in, no matter what the yield offer may be. So my conclusion after a decade in the making here is that lending is passive, right? Substantially more passive than rental property ownership. It's definitely scalable, and it's non-correlated, right? When the stock market's going all crazy or it's in the tank, mortgage investing or private lending is kind of insulated from a lot of those auxiliary economic factors, especially if you are lending at lower loan to values, which if you're going to get one thing from me in tonight's talk, it's going to be that, you know, don't chase a high yield, right? Safety over yield always, right? And I find a lot of new folks that I'm working with are kind of blinded by yield and don't really understand the underlying risks associated with the lending. So my new goal, right, instead of owning 10 or 15 rental properties free and clear and riding off into the sunset or hanging out on the beach someplace, was that I think I'd like to have $3 million in performing low leverage first lien debt, earning a very safe 7%, right? That's going to afford me the lifestyle that I want to live. And I'm a very active person. I probably won't retire, but I certainly won't be strapped to a desk or, you know, responsibilities to an employer or a boss. I could be my own. So in any case, I wanted to break down kind of private lending versus buying notes, because I think there's a lot of, you know, conversation and buying notes or buying trust deeds. That's very popular buzzwords today. So private lending is the origination of a brand new loan, at least to me, whereas buying notes or buying trust deeds is like a secondary market transaction where the loan isn't actually changing. It's the investor behind the scenes. Maybe the original lender has collected payments for some times now and is selling off the loan in the secondary market. Another example would be, and it's kind of also getting some notoriety today, people are kind of more publicly getting involved in non-performing loans, perhaps where the bank is, you know, in distress and is selling off in a secondary market for cents on the dollar. So kind of understand the difference between private lending, originating a new loan, versus a secondary market transaction where you're buying the loan or the stream of payments from another. Opportunities in both. My experience has been heavily on the private lending side, although more recently in the past handful of years, I've been getting involved in the secondary market. Some goals of the presentation, very simply, I want to share what I've learned, what's important in loan investments, at least from my opinion and my perspective, and then kind of understanding some of the associated risks and how to mitigate those risks. To me, there are 4 primary factors to consider when lending money, right? I have those on the screen. The lien position in the security, your collateral asset, your loan to value, and the occupancy of the asset. Take note that the yield and the borrower credit profile to me are not listed as primary factors. Okay. And again, I mentioned before that a lot of new folks approaching me and approaching Marshall Reddick looking to get involved, they want that double-digit yield, right? They want to chase that high return, and they're kind of blinded by potential risks. And they really think that it can't happen to them, or that it won't happen to them, that they would have a default, or they could end up losing money. And I've seen it happen over and over again. So don't chase the high yield. And certainly if the borrower credit profile is available and it's accurate, great. It's always good to supplement. But I feel that if you follow these primary factors, that from a private lending standpoint, that the borrower credit profile is less important than the collateral and these four factors. So number one, security and lien position. So I'm very, over the top. I truly insist that unless you're a sophisticated investor with a very healthy risk appetite, that you invest only in secured real estate loans, right? They must have real estate backing. And for me, I'm a residential guy, right? And just my upbringing and my experience with Marshall Reddick, we do nothing except residential real estate. Multifamily property is okay, but smaller multifamily. And in my preference is going to be single family homes. They're much more easily tradable in the event you have to own the asset. So in any case, don't make unsecured loans. And collateral that's other than real estate, it's just not my experience or not my bag. Do yourself a favor though. Do not invest in junior liens. Very risky. And again, having learned the hard way, I originally early on in my career chased those high returns, 20% yield or greater, lending in second position. And I had a deal go sideways, and the first went delinquent, fix and flip loan, and foreclosed. I was in junior position, and the collateral asset just did not have the value for me to risk paying off first, even though I had the capital to do it. I just had to bite the bullet and walk from that $50,000 second position loan that I had. And I got to tell you, that was extremely painful, but it was an excellent learning experience, and certainly something that I will not replicate again. So you have the luxury of learning from someone who's been investing heavily in private lending and has learned from those experiences. So if I can just harp on it once again, please, real estate secured lending and first position lien debt only. I mentioned, but there isn't a yield great enough for me to gamble that hard-earned cash. We all work extremely hard for the money that we have saved, whether that be from employment or from investing and so on and so forth. It's just not worth gambling on an unsecured loan or a junior lien. And you really are gambling when you're undertaking one of these two, or a number of other factors, but these are two primary. With first lien security, you always have the collateral property, right? So even in the event of default, which I'm going to talk about defaults being a part of the business, you can always foreclose. So that first lien debt, a very safe place to be. Moving on, number two of the primary factors would be the collateral asset. Always ask yourself this question. Am I okay owning the collateral property for the investment amount? Right, plain and simple. Am I okay owning that property? And I've got this dilapidated property here on the bottom of the screen. People don't ask themselves these questions, right? They just make the loan. Oh, it's 12% interest. It's short term. I'm going to make a really good pop on this loan. It's not going to go sideways, right? So ask yourself this question, because the absolute worst case scenario, anytime you lend money, is you're going to have a default. And in a default situation, if you can't work something out with the borrower and you have to enforce your rights, you're going to move to foreclose. That is your legal right as a secured lender, a secured lien holder. And so if you have to go own that property, feel good about it, right? Because you're okay owning that asset for that loan amount. Moving on to loan to value, it's key to evaluating risk, and very simply put, the higher the loan to value, the higher the risk, and generally the higher the yield, right? The higher the risk of any investment, I'm sure everybody realizes that you should have a higher yield. And then the opposite of that, the lower the risk, usually, or the lower the LTV, the lower the risk. Generally speaking, you're going to have a lower yield, right? But from my perspective, I've originated somewhere in the neighborhood of 2,000 loans at this point in time. I will always take safety over yield. Trust but verify, right? And that goes with any type of investing, but a lot of promoters out there, they're starting more and more technology-based companies, very good websites popping up, and will give you opinions of value for the collateral asset and loan to value. But you have to be very careful about that, because without some kind of verification, I've got appraisal on the screen. If it's possible to obtain third-party appraisal, you absolutely should get it. So like with private lending, where there's a newer loan being originated, an appraisal is always applicable. And we use an appraisal management company just like a conforming lender would, so we have a legitimate third-party appraisal depending on the type of deal. Now, if you're getting into something more sophisticated and you're looking at buying a secondary market transaction or a non-performing loan, you might not always have the ability to get a full interior access appraisal because the borrower may have no idea that the loan's even being sold in the secondary market. Usually they don't. And in the case of a non-performing loan, you may have an adverse borrower who's under distress and is not going to want to hear from some third-party creditor about having access to their house. But if you can get that appraisal, right, that's going to really help you establish what your true risks are by understanding more what your true loan to value is. The other ways to do it, BPOs and drive-bys, those are all good, but third party, don't always take who the promoter is and what their opinions are, what their data is. Depending on who you're working with, there are, and I've learned, a lot of non-reputable promoters or brokers or people in the market who are not interested in building relationships with capital partners long-term, who are interested in just getting one deal done. And if you take the hit and it's a bad deal, they just have no regard or care. A good rule of thumb: don't chase the high yield. I've mentioned that a couple of times and I hate to harp on it, but really start small, start safe, and understand what you like and what you don't like when it comes to lending or investing in loan-based investments. My last and final of the 4 primary factors to consider would be occupancy. And from my perspective and from my experience, I recommend investing only in non-owner occupied lending. The private financing offered by Marshall Reddick is strictly non-owner occupied. And there's several reasons for that, but really what it boils down to is that, in my opinion, the risk is exponentially higher due to an emotional factor with an owner occupant, and also that their ability to service the debt is based on their employment, right? They don't have the ability to rent the property, at least not in the traditional sense. And from an emotional standpoint, if they get into a rock and a hard spot and they can't make the payments, right, they're going to be embarrassed. They don't want their neighbors to know about it. Their kids live in the home, most likely. You know, they're going to be someone who's going to, in the event of default, without a doubt, more likely to contest your foreclosure or be less inclined to want to talk to you or work something out with you. It's just going to complicate things, and this will translate into a much more expensive, more lengthy, and more risky foreclosure process, as there's just simply more opportunities for something to go wrong, for them to be upset with you as a creditor, to damage the home when they realize there's a point of no return and they're going to lose the home. As opposed to when you're dealing with a non-owner occupant, you don't have that element of emotion. It's really a business transaction. The equity in the home is there or not, right? And it's going to be a less expensive, a less lengthy, and a less risky foreclosure. So occupancy is key to me. And again, I recommend that you consider non-owner occupied lending or loan investments only. Defaults, a part of the business. If you're going to lend at any type of regularity or any type of scale, they will happen, right? It's just part of the business, and you just have to kind of factor that into your overall schematic, into your overall strategy, into your overall yield requirement. But if you take into consideration the four primary factors that I mentioned, you should be okay, right? If you've taken those four factors into consideration in the event of default, you're certainly going to have to do something. You're going to have to take action in terms of hiring an attorney and some other loss mitigation tactics, but you should be fine. You should not have any loss of principal, of course, depending on economic factors. Talk briefly about performing versus non-performing. Seems that non-performing is becoming more and more popular as technology kind of expands, and social media and websites and so on and so forth, and the bigger pockets and those types of forums. I have had some experience in non-performing. I was a part of a fund that bought batches of junior lien mortgages, usually with owner occupants, at 8 to 10 cents on the dollar, and attempted workouts with those homeowners, and that was not a good experience, right? Talk about earlier on where I came from in my rental property initial motive when in real estate investing, and how active that was. If you are a busy professional and you don't do this full time, non-performing notes is definitely not the space for you. It is more active and more regulated and more time consuming than rental property would be by far. So, but to define the two, a performing loan is simply a borrower in good standing. They're making their payments and you're expecting it to continue to do so, right? From a non-performing standpoint, they're in or near default, payments are not being made, or they're expected to become delinquent. So my question to anybody thinking about doing this is, why would you want to invest in a non-performing loan? And the answer to that question is because you want to chase that high yield. And for professionals who really know what they're doing, there is an opportunity to make some big rips in the non-performing space. But talk to how I mentioned defaults being a part of the business. When doing non-performing, you just have to understand, especially in a junior lien position, that you're just going to get wiped out and lose on several on a percentage basis, right? If we're talking, I don't know, I would maybe say even at 50-50, 50% you're going to be successful in that non-performing space, and 50% you're going to lose. Right? So hopefully your 50% that's going to win is going to win big enough to offset those losses on those where you get wiped out or lose. Outside of the four primaries, some other important information I'm going to run through. These 8 are definitely to consider for folks looking to get involved in lending money or into loan type investments. From a loan documentation standpoint, the package today, I'm sure, is Carrie and those in the conforming lender space, the loan document package is like an unbelievable amount, and nobody reads that documentation anyway. They're just signing their life away. But when it really boils down to it, in a loan origination or in a private lending standpoint, we're talking about 2 documents, right? Promissory note and mortgage or trust deed. The promissory note lays out all the terms of the loan, and the mortgage or trust deed, which I refer to universally as a security instrument, is based on the state, right? Some states are mortgage states, some states are deed of trust states. California, where we reside, mostly is a deed of trust state, whereas Indiana or Ohio, mortgage states. But either way, this is a security instrument. It is recorded in the county where the collateral property is located. And it provides that public security, that lien position, so that the borrower cannot sell or convey the property to another, at least not without title insurance, without satisfying your lien. In the secondary market space, or in buying notes or in buying trust deeds, the other document would be an assignment of security instrument. So an assignment of mortgage or an assignment of trust deed. And this functions similarly to that mortgage or trust deed, but basically this document would also be recorded in the county where the collateral property is located, and it would effectively transfer the interest from the lender named on the mortgage or deed of trust or the creditor to the assignee, right? So in a secondary market transaction, the note and the original security instrument do not change. They remain in effect. It's just the assignment of those documents and that collateral, that position against that collateral property are transferred. Escrow and title, mandatory, right? Do not ever do a transaction, real estate transaction without a third-party escrow company, and always from a lender's perspective, obtain a lender's policy of title insurance, right? Guaranteed, your conforming lenders out there, when you're buying rental property or buying your performing, they're 100% without a question, always using a third-party escrow company and always obtaining a lender's policy of title insurance, period. Escrow handles the documentation and the money, earnest money, down payment, loan funds, so on and so forth. So when somebody approaches you in order to, lend them money and they say, just wire it to me directly, absolutely not, right? You go to that third-party escrow company that's not partial to the other, and that escrow company will make sure it's a legitimate transaction. Will not close that transaction until all the loan documentation is good and in place. As far as title insurance, different than homeowners insurance, it insures in the rears, right? So it will insure against prior defects in the title, whether that be prior lenders who maybe didn't get paid off or mechanics liens and all of the sort, right? It also insures that lien position, in my case, as a first or primary lien. Property taxes, delinquent taxes take priority over secured lien holders, right? That's something to consider. So impounding or an escrow account, if possible, is best, right? But that's not always possible. But if it is, you definitely want to do that. And I'll take a minute if you're not familiar with an impound account, the breakdown of your taxes and your insurance into 1/12 of their annual cost, and you include that along with your principal and interest payment. If you weren't familiar with that term, most of you who own rental property or primary probably have an impound account wherein you're making one payment and the lender on your behalf is writing a check to the county for the property taxes and to the insurance for your annual insurance premium. That certainly gives you a handle on ensuring that the property taxes and the insurance are paid. If you can't or don't want to have that impound account, you can mitigate your risk there by using a third party. CoreLogic or a company called Loretta offer a service for property tax tracking for a one-time fee, very small fee, will alert you when property taxes go delinquent in the county where the property is located, the collateral property. Taxes, generally not a huge risk on the short term. Most often it takes years for adverse action to happen. California, for example, they literally, the counties will let the taxes go delinquent for 5 years before they will auction that property. In other states, it's a little bit different where they will, sell off a tax lien to someone who will slide in and take a lien position that is in advance or ahead of your secured position as a lender, but they can't do anything adverse for probably several years. Usually not an issue as long as there's equity in the property for the borrower to protect, but definitely you want to make sure that property taxes are getting paid by your borrower. Oftentimes, I look at it from the perspective of if taxes go delinquent, most likely your principal and interest payments not being made or is going delinquent, so you'll have a good idea. As far as hazard insurance, this is a huge risk to the lender, right? And the question is what happens to if an uninsured property burns to the ground? Well, that's a massive problem, right? The borrower would still owe the debt, right? The unpaid debt that is owed to you, but it's a lot more difficult for them to repay that without the collateral property or a burnout or a significantly damaged total loss property. you still have that lien position, and it's still secured against the land and any property that's remaining. But you need to ensure that the property remains insured at all times, and that, you know, it's obviously a borrower paid expense, but borrowers oftentimes don't do everything that they're supposed to do and may not realize the associated risks. Because, I mean, think about a conventional lender, right? That's got doing an FHA loan or something, very low down, 97.5% loan to value, and they let that insurance expire. What does that borrower care? They've got 3.5% skin in the game. They're just going to walk away and leave the lender holding the bag. So again, impounding is best, but if that's not possible, at least work with the insurance agent that the borrower has hired, and add yourself as mortgagee, right? Any bank or any conventional lending institution is going to do that, and you can simply work with the agent to have yourself or your loan servicer added as the mortgagee. And what will that do for you? The insurance company then is required to mail notice if there's a missed premium payment, or if the policy is going to renew, or if the borrower tries to remove you as the mortgagee, right? You're going to get that notice, and you're going to get at least a little bit of time, a week or two, maybe 30 days, to do something, to take action, to contact your borrower, to contact the insurance agent. And in some cases, if you can't get a hold of anybody, ultimately as a lender, you can force place a policy of insurance to protect your interest in the property. Loan servicing, this is akin to a property manager for your loan, right? And they do a lot of different things. I definitely recommend third-party loan servicing. A couple of items that the loan servicer, that their responsibility, I've got on the presentation slide here, the monthly statements, the documentation, and the payment history, all online. And this is important too if you have a loan investment and you choose or need to sell it on the secondary market at some point in time. It's substantially easier to do so if you've had it serviced by the same loan servicer for the time that you have owned that loan, right? Because you can go back to that loan servicer and ask them easily to provide you a payment history report and any of the collateral documentation to be able to provide to any potential buyers willing to buy that lien position from you, replace your cash, and take over the payment stream. So definitely, as far as accounting and payoff, I have some lenders once in a while, or capital partners, ask me like, well, there's an associated cost and I'd prefer to do it on my own. And I say, look, what happens if you get busy and you do not a great job of accounting, and the borrower makes some erratic payments, maybe a couple of additional principal payments per year, and then 5 or 6 years down the line, they call for a payoff. You get a call from an escrow company that says, hey, this loan's going to pay off, and you literally have no idea what the remaining principal balance on the loan would be. That would be a problem. So as far as lending, and it goes with Marshall Reddick, on our long-term programs, loan servicing is mandatory. So as far as rental property, most folks, and I know that I wouldn't in most cases, I wouldn't own rental property without a property manager, and the same logic applies here. I wouldn't lend or invest in loans without a loan servicer. And again, that applies to most cases. Some of the loans that we originate and that I have lent personally are very, very short term in nature with interest only payments. And in that capacity, a loan servicer might not be necessary or super beneficial, at least to outweigh the costs of the associated loan servicing. As far as foreclosure goes, a lot of folks I work with really just think like, oh, if there's a default, I just magically get the property. And that certainly is not the case, right? There are legal channels that you need to go through. And I like to describe that the foreclosure process varies by state. Each state has their own little nuances, but it ultimately culminates with an auction style sale. And depending on the state, that's a trustee sale or a sheriff sale. And there's a number of things that lead up to that, and notices and things that you must do. You as the lender will not be doing that most likely. You will hire a third party. Generally, that will be an attorney, although it doesn't have to be in a trust deed state. But ultimately, at that auction style sale, the lender will establish a credit bid. okay? And that credit bid can be any number that you like, except it cannot be more than the total amount that you are owed. And the total amount that you are owed would be your principal, your unpaid principal balance, your any accrued but unpaid interest, any property taxes, insurance, or other advances to protect your loan security, right? If you've had to pay the property taxes or insurance on behalf of the borrower because they let them go delinquent. And any associated like legal or attorney or foreclosure costs, right? So you can add up all of those, and that's the maximum credit bid, right? And if you're in a great lien position, right, and you've got very low loan to value in first position, then go ahead and make your maximum credit bid. Because if you're in a good position at that auction style sale, some flipper is going to be there to bid on that property. And if there's someone there to bid over and above or equal or over and above to your credit bid, then you get paid on the spot. Okay. Now, in the event we're in a massive recession or you're at a very high loan to value, right, and maybe the collateral property is not worth what the total amount that you're owed is, you may choose to lower your credit bid. And you can do so and establish the minimum amount that you're willing to take. And oftentimes in that situation, I encourage clients to do that unless they prefer to own the property. Because if the collateral asset isn't worth what your credit bid is, guaranteed there's going to be nobody there to bid on that, because those folks bidding at the courthouse are going to be super professionals that know what they're doing, that are looking for a steal of a deal. So if you're okay owning it, then go with that credit bid in the event the collateral assets in an upside down position. As far as the differences in state, the mortgage states are judicial foreclosure states, right? And then that state, in that consideration, it's going to be harder, slower, and more expensive. And that all revolves around the fact that there's court involvement. You literally have to file a lawsuit in the court and go before the judge. You don't, but your attorney will, and say, Judge, please look, the borrower's in default. May I please foreclose on my lien and enforce my rights, right? So with that, right, court systems, they take forever, right? They're expensive, and there's legal fees and court filing fees and all of that kind of thing. So from my perspective, it's definitely wise to stay out of states with adverse foreclosure laws. An example I've got here in Florida, that's probably the most adverse state in which I lend and Marshall Reddick lends. And we're talking, I've been through several foreclosures there, 65 to 7,500 and 6 to 9 months time. And that's an uncontested foreclosure. And that is a pre-COVID timeframe. So due to COVID, there has been, courts have been closed. And those that are now back open and actually entertaining foreclosures, they are so backed up. It is not a good time to be in a mortgage judicial foreclosure state and have to go through that process. I suspect 18 to 24 months potentially could be the case. You certainly do not want to be in that position. As far as non-judicial or trust deed states, substantially easier, faster, and less expensive. There's no court involved. You will likely hire an attorney to be the trustee that you need to help you, and they're familiar with all of that, but it's not going to go through the court system, and you're not going to have to ask that judge, at least in a non-contested situation. An example here would be Texas. Texas and Arizona are pretty close and the fastest states in the union, and we're talking about literally 3 months. You're in default, you haven't made your payments, you file a notice of default, you post at the courthouse, and you're at the courthouse steps auctioning that property to the high bidder. A little understanding there about the foreclosure process. An alternative to foreclosure, and there are several loss mitigation tactics, would be a deed in lieu of foreclosure. Right? Again, this is just an alternative. And in this case, the borrower must agree. And logistically, what's happening is they're simply signing over a deed to the collateral property and therefore transferring legal title to the to the lender, excuse me, without forcing the lender to into that foreclosure process. Now, guaranteed, right, your owner-occupant situation is not going to voluntarily give you the deed to the property. Right, so it goes back to the occupancy is one of the primary factors that I provided, and they're going to drag that foreclosure process out as long as possible. try and save that home. And so, you know, deed in lieu is certainly a good option. And you, although you don't want to own that property, it might be a faster, less expensive, and easier way for you to get the collateral property back so that you can decide the best route, what to do with that collateral property in order to get your money back. Because after the deed in lieu, the loan is complete, right? Now you own the collateral asset instead of the lien position against the collateral asset. So that is a little, we'll conclude the portion of this educational portion, I should say. And now, if you don't mind, I'll just give a brief overview about what Marshall Reddick does and wish you guys a great evening. Does that sound good?
That sounds great. And maybe open it up for question and answer afterwards.
Of course, I would be happy to answer any questions that you have, and no rush on my end. I just want to be cognizant of your time. I'm sure you've got other things to talk about as well. So,
sounds good. So go ahead and finish on Marshall Reddick. I'm curious about your.
Yep. Absolutely. And thanks for the introduction on Marshall Reddick earlier. We're not a super large business, so I wanted to kind of establish that. We have grown substantially, and we've changed substantially since the time that Marshall Reddick, the founder, who is actually an individual in his late 70s now, founded the business in the late 70s. But what do we do exactly? Well, we offer services first and foremost. So we have a functioning brokerage house. We help people buy and sell 1099 agents, just like a Keller Williams or a Remax. We offer property management services in all of the markets that we have our own license and where we have our own brick and mortar office where that brokerage is located. And we also, of course, offer the private financing. And in addition to the services, we offer investments. So those clients who look to invest with Marshall Reddick, we allow real estate investments, right? So rental property ownership in all of the states in which we operate. And we have our own brick and mortar offices with our own property managers and our own contractors and our own W-2 employees and our own boots on the ground, if you want to call them that. And so we work with builders and all these different types of elements to give you opportunities or to bring you opportunities to invest in rental property if you're not sure where to get started. We also, of course, do the private lending, which is the back end of private financing. So kind of a footprint of what we look like today. Our corporate office is in Newport Beach, and that's the office in which I work out of. We also have an office in Los Angeles, 2 now in Texas. We have an office in Clarksville, Tennessee, which is north of Nashville, northwest, about 45 minutes. And it's right there on the Kentucky border. So we have a license in both Kentucky and Tennessee, and we have a small operation on the Kentucky side. There's a bedroom community there that's really a part of Clarksville called Oak Grove. A lot of good deals there. And our most recent office is in Southwest Florida in Cape Coral. So likely have a few more offices to open in the next 5 or so years, but we always focus on very large metropolitan markets. So Phoenix is on that list and Dallas is on that list. As far as private lending and the division that I run and manage and kind of built from the ground up, we offer and arrange collateral-based first lien private loans to borrower clients that have a niche situation, a situation that simply a traditional or conforming lender simply can't. As the bottom line is in real estate, if you can get a bank loan based on the asset and the situation or based on your credit or whatever, go with a bank loan, right? If you've got the time to wait for that conforming lender to get it done 30, 45, even 60 days, by all means. But there's a number of situations, and we service those niche situations when bank financing or traditional lending is just not available or there's not time for it. So example number 1, long-term rental property financing for self-directed retirement accounts. I have a self-directed IRA LLC myself. I have for a decade. I own rental property inside of it. There's just a massive market for this type of financing, and overall, in the grand scheme of things, very few lenders making non-recourse loans. For those unfamiliar with non-recourse loans, You always have the ability as the creditor or lender to foreclose on the collateral asset, but non-recourse simply means you cannot pursue the assets of the borrower after any foreclosure should there be a deficiency balance. So your collateral is the property and the property only. This is specifically offered by Marshall Reddick only in self-directed retirement account situations when we are legally required to do so. Self-directed retirement accounts, 401ks, are protected much like pensions, and any type of default or bankruptcy situation, you can't pursue those assets. Example 2, short-term, ultra short-term, 12-month maximum loans, fix and flip. Some folks are getting more creative with a term called BRRRR to establish rental properties with potentially less money down than the traditional buying straight up. But either way, these are short loans, very high loan to value, much higher interest, but we're making these loans only to professional borrowers. And in 90, 95 or better % of the time, it's a pre-existing relationship. And what I mean by that is we don't make loans to random borrowers at high LTV, short-term, hard money loans, if you will. So you can't just call me up and say, hey, Pat, I watch HGTV. I know how to flip property. Can I get a hard money loan? It doesn't work like that. And those familiar with Marshall Reddick and kind of know that our fingers are all over the country. Pre-recession of 2008, we were operating in 200 cities. And that was not necessarily a sustainable model, but I was around at that time and I have maintained those relationships in almost every major city around the country. So those relationships today afford me a phone call away, somebody who can help me, whether that's a broker or a property manager or a contractor or an attorney or you name it. So those are the two primary examples of the niche situations. There are many, many others where the traditional lender simply can't perform. We establish our own proprietary and internal guidelines, and it's important to understand that these guidelines are not tied to any type of government action, or they're not tied to, or at least today, or tied to what's happening in the overall economic market, right? So in establishing our loan to values and establishing our interest rates and our loan fees, we make those up for the most part. Now they're very competitive, and they're very competitive because we want to attract the best of the best borrowers. I could probably charge 2 or 3 or 4 times more on my short-term financing, but I'm going to be getting those weekend warriors with less experience that are going to translate into more defaults. Instead, I need to offer superior loan-to-value rates, terms, and so on, especially on that short-term financing, to be able to attract the most professional, most experienced borrowers. It also is important to understand that we underwrite every single loan in-house. I have a team of analysts, a part of an underwriting team that work under me out of the Newport Beach office, right? Back in the day when I started this, I was everything. I was the underwriter. I was the document preparer. I was the person handling all the third parties. As we've scaled this and we're funding someplace in the neighborhood of 35 to 40 loans per month, I have a team now, and that's allowed us some scale. So understand though, when you look at our website and our marketplace that we have available for private loan investments, that every loan there fits the Marshall Reddick guidelines and has been underwritten and approved by a Marshall Reddick W-2 analyst that is trained under me. That's extremely important to understand, that we are not the Amazon of loans, and nobody can go to our website and upload garbage, and we're not promoting it just to make a loan fee, regardless of what happens to that lender or that capital partner. Instead, we're much more interested in originating good loans and building relationships, long-term relationships with our capital partners. So as far as Marshall Reddick and allowing clients, right? Because one of the big things that's important to understand is deal flow, right? And where do you go find private loan investments? So we allow you to do that, right? And we do that, first off, the web address on the screen, right? marshallreddick.com/mortgages is our open-ended marketplace. Anybody can go there. You don't need to sign up. You don't need to pay money, and you can review. And basically, I like to refer to this as a multiple listing service for loans. Okay, there is a listing very detailed for every loan that's available. And we tell you that it's a purchase money loan. We tell you that it's a refinance. We tell you what the exit strategy is, whether it's hold or whether it's sell. We tell you the loan to values. We provide you with a copy of the appraisal. We show you photos of the collateral asset, so on and so forth. Is all the data that I believe and that my principals at Marshall Reddick believe is necessary for a third-party lender or capital partner to evaluate whether that loan is good for their risk appetite is there. And I might add again that we only originate or sell first lien position debt. So as far as the two ways that we allow for our clients to invest in mortgages would be either number one, direct lending, or number two, the Marshall Reddick Mortgage Fund, right? In the direct lending, you choose the loan. You own the loan, you're named on the loan documents, right? Marshall Reddick is acting in the capacity of a broker, right? And we are organizing or arranging the loan between borrower and lender. And historically, over the past decade, this is how we have built our lending business. But over that decade of learning and building and increasing and so on and so forth, it's not a scalable model, right? I'll give you an example. So December of 2019 was our largest record month, right? We originated 47 loans that month. So not only did I take the loan application, do the underwriting, communicate with the borrower, get them into a loan program, and then published that loan as available, then I had to sell 47 different capital partners to say yes on each one of those loans and organize them to get the money into escrow with insurance, title insurance, loan documents, so on and so forth. That could get a little hectic. Okay, so in addition to the direct lending, my capital partners have asked for a syndication or a mortgage pool, and that is new. The Marshall Reddick Mortgage Fund is a 506C under Regulation D of the Securities and Exchange Commission Private Placement Memorandum. Looks like I jumped the gun. I would like to go back on the direct lending. It's one lender on one loan. We are not fractionalizing those loans, right? I'm not going to take 10 different capital partners that don't know each other and all put them onto a single first lien position deed of trust. So whatever the loan amount is on that mortgage marketplace that you would like to invest in, you must have 100% of that capital. No crowdfunding, same kind of concept. Going back to the fund, you invest in the fund. You become a shareholder. $25,000 minimum investment. The fund owns the loans, right? It only makes the same loans that are available right on that mortgage marketplace, 100% originated in-house by Marshall Reddick. The fund owns the loans. The fund is named on the documents. The fund earns the interest. And separate from the direct lending, the fund also earns the loan fees. When I say loan fees, I mean the borrower fees. Whereas in the direct lending, the lender earns 100% of the interest. Marshall Reddick doesn't take a piece of that, but we do earn the loan fees or the points paid by the borrower upfront. That's different in the fund, right? So the fund, again, is earning the interest and the loan fees. The shareholders in the fund are earning quarterly dividends, right, based on the overall profit of the fund. Marshall Reddick makes money in the fund by earning an asset management fee, right? And that covers really staff costs. That's not a profit center because the fund has no employees, right? I'm an employee of Marshall Reddick, not of Marshall Reddick Mortgage Fund. So in order to be able to pay the staff and the analysts on the underwriting team and the processing team, Marshall Reddick earns that asset management fee, 2% of net assets under management annually. And we also earn a profit share after the shareholders earn their preferred 6% return. I might also note that you must be an accredited investor. I won't take too much time to harp on unless people have questions about what it qualifies to be an accredited investor. So I'm a busy person. I would love to speak to all of you, but and I'm an old-fashioned telephone guy. If you can't get me on the telephone or a text message right away, I encourage you to reach out to the staff on my team. These are well-educated, well-experienced folks, and I provided their contact information in the event that you can't get a hold of me. But otherwise, I would love to speak to you, and I've got my contact information on the screen. And that concludes what I have prepared, and I'm open for questions, anybody that has any. Thank you again for the time.